This number typically is very high when you have big stock bubbles. For example, at the peak of the NASDAQ bubble, it was over 40. By the time uh, we got to crash of 2008, it was 14. So when it is too low, you can think of it as it's time to buy stocks in general. When it is too high, it's time to sell. And right now, it's pretty high. In fact, we are pretty much at the same levels that we were post-COVID recovery. So there may be some expectation of a correction, but there is one difference. S&P 500 is a collection of 500 stocks, but the bigger the stock, the higher its share. The five biggest stocks in S&P 500 are NVIDIA, Apple, Microsoft, Google, and somebody else. These guys are about half of S&P 500. Back in 2021, that wasn't the case. So this number is high partly because index is driven by 5, 6 stocks. So you need to be kind of careful about those as well. But if this reaches about 45, I'm going to tell you guys, dump all of your stocks. And we talk more about these in portfolio management classes if you're finance majors, because there are ways to uh, kind of figure that out. Now, there are a few more uh, price multiples. I'm going to briefly talk about two of them first. One of them called price to book ratio. That's price divided by book value of equity per share. One of the reasons you may want to look at something like this, if earnings are negative, PE ratio doesn't mean anything. I mean, what do you mean it's negative? Think about that interpretation. How long does it take you to recover your investment? Well, a negative time, unless you're doing quantum mechanics around black holes, doesn't mean too much. It basically says what sort of premium market attaches to the book value. Remember, book value of equity is book value of assets minus liabilities, and book value of assets are kept at historical cost minus any accumulated depreciation. And there are even certain assets that have zero book values, even though they're very valuable. All of the patents for NVIDIA's products, they have zero value in their books because they've been internally developed. They haven't bought them, but we know how valuable those are, right? So looking at, again, we can get these from the published financial sources. For Delta, price to book is 229. That means market is attaching 129% premium over the book value. And for Southwest, 212. They're roughly the same. I mean, remember, these things are based on estimates of things. So 2.3 versus 2.1, I wouldn't do a trade based on that small difference. Another one is called price to sales. As the name suggests, it's price divided by sales per share. It is not a very useful ratio, but sometimes, especially for startup companies, book values may even be negative, again, which makes price to book meaningless. Back in the beginning of the internet boom of late 90s, this was actually used quite a bit to make comparisons across firms. So I'm not even sure these statistics have them. They do. And let's look at delta 0.64. Again, not too different. As long as firms have relatively similar profit margins, you can make a comparisons like that. But if they have wildly different profit margins, it could be misleading. I'm talking about these just for completeness purposes. There's one last ratio I'm going to talk about and send you guys home. This is called EV over EBITDA. EV is short for enterprise value, and this is earnings before interest, taxes, and depreciation. In general, non-cash costs, but we just call it depreciation for now. And the way to define EV, market cap minus uh, plus liabilities minus cash. I put that cash, technically this should be net cash. This is cash plus short-term investments minus short-term liabilities. You can think of market cap plus liabilities as kind of an estimate of market value of the assets. So what's the market value of the business, in a sense, right? Not from the stockholders' viewpoint. You know, if this firm was 100% equity valued, what would have been its market value? And by taking out the net cash, that part, it's short-term financial management. So you're taking that part out. You're basically looking at the long-term value of long-term assets, in a sense. Okay. Again, when you're doing this for a living, I would use my own numbers, but for quick stuff, it's a good idea to look at the published numbers. So for delta, EV over EBITDA is 9.10. So it takes you about 9 years to recover your enterprise value. Remember, market's value of equity is based on the stock price, right? Using your EBITDA, let's look at same number for Southwest, about 8 years. So based on this measure as well, Southwest is doing a little bit better. And EV over EBITDA is typically calculated using trading 12 months earnings. If we looked forward-looking versions of those, probably we would have gotten more advantage on Southwest. Well, let's stop here. I'm gonna post all your groups and stuff tonight, and the homework assignments that's gonna be done with the group will be posted tomorrow afternoon, and you will have till next Friday, end of day, to do it. It is somewhat a lot of work, but since you got 3 people, you're gonna get some. You're gonna download financial statements, calculate some financial ratios, and I'm gonna ask you guys interpretation questions. I am more interested in those. Basically, what do you do with these numbers? To each group, I'm gonna assign a pair of company. So final question is which one of these companies you want to buy and why. All right? See you guys Monday.